Hello and welcome to Chapter 8. Chapter 8, we're going to talk about receivables. What we're doing now, if you remember what we've kind of done, is we started at the beginning of the semester, we looked at the entire balance sheet. We looked at it in total for each one of the amounts, or for each one of the accounts. And now what we're going to do, and we're continuing kind of the discussion, we looked at cash a little bit. The last chapter we looked at was Chapter 6. In our discussion, we looked at merchandise inventory. Now we're going to the next step on the balance sheet, and we're going to look at receivables and different types of receivables that a company has. We're going to break the receivables down into accounts receivable, sometimes called trade receivables, and then we're going to look at other receivables and notes receivable. And we're going to talk about the treatment of those different types of receivables on the balance sheet. As soon as I can get this slide to move forward. Okay, there we go. The first one we're going to talk about is the different types of receivables and how you journalize sales on credit card sales, and debit card sales. The first, credit card sales, is going to look very familiar to you. Credit sales is going to look very familiar to you. It's something that we've done before. It's something that we looked at the beginning of the semester, and we're going to continue to look at it, and we're just going to look at pieces of that going forward. The other two, credit card sales and debit card sales, are a little bit different because you pay the credit card companies for the right to take their credit card when you buy something, and I'll get into a little bit more detail of that here shortly. What are the common types of receivables? A receivable occurs, as the note here says, when a business sells goods or service to another party on credit. So if the school bought office supplies, say if Commerce bought office supplies from Latson's Office Supplies, and Latson's doesn't collect cash when they drop them off, they're selling us office supplies on credit, and they expect us to pay for that sometime into the future. And that's going to be considered a receivable. And so they're a creditor to us, and we are their debtor, these last two notes on the bottom. And you have accounts receivable, sometimes commonly known as trade receivables, and typically it's going to be between 30 and 60 days. Some businesses will be faster. Think about businesses that sell, say for example, milk. Milk, because we know that milk turns and they have to sell it fairly quickly, convert it into cash. Milk processors generally are probably going to have lower credit terms than 30 to 60 days. They're probably going to be like maybe 7 to 14 days because they know if they don't sell the milk, they're not going to get their money. So they want to get that money from their debtors a little bit faster. And that's accounts receivable. And I know you're familiar with that. Notes receivable typically is longer term, and it might be a business-to-business sales transaction. But the biggest thing is it's a lot more formal in the sense that it's given for a specific transaction, and there's interest associated with it, and there's also a maturity date. So all of those things revolve around a notes receivable on a business's balance sheet. It might be that my business decides to buy land from another business, and the other businesses I'll be willing to finance your land purchase, and you're going to have to pay me at XYZ date, and they might have to pay you a certain amount each month as well, using something called an amortization schedule that details how much they're going to pay and how much the loan is going to go down on a go-forward basis. And you have other receivables for a business. There's a few here, and other receivables are things where the business expects money to come in. And here they use dividends receivable, interest receivable, and taxes receivable. There's one that's not on here, but I think it's kind of interesting to deal with, and it's employee advances. In particular, employee advances, and some of you guys will get involved in this with the business. They're not nearly as common as they were, but if you're going to travel and you did not have enough money or enough credit balance on your credit card, your company might advance you money when you travel, and then when you come back, you have to do an expense report to compare the amount of money that it cost you. Let's say they advance you $1,000 cash, or in a check that you do cash, and then you have to, when you come back, you take all of your receipts and you compare how much they gave you versus what it cost you, and you either give them money if it costs you less than $1,000, or they pay you if it costs you more than $1,000. That's that travel advance is typically what you might see as well. That's another type of receivable. How do we do a sale on credit? Well, we're going to talk about that, but what we're going to do here is we're not going to look specifically on sales with a cost of sales. And you notice here you have two different sales on credit. You have first, you have accounts receivable Brown, and then you have service revenue, and you have accounts receivable Smith and sales revenue. So they made two sales. Now I want to make something really clear on this particular slide, however. They have accounts receivable and it says Brown, but really in the general ledger system of a company, they're not going to have an accounts receivable account for each person in their general ledger system. They're going to have something called a subsidiary ledger where we're going to have accounts. Imagine at the university if they had an accounts receivable for every student in the ledger for the school. So you'd have accounts receivable Smith, Mary, Smith, imagine all the names. So what they do is all those names of all the students are in a separate and distinct subsidiary ledger that foots and balances to the balance that you have in the general ledger. And you only have one account that's called accounts receivable on the ledger, but it's going to have account names it's going to have people's names or a list of accounts with those names in the ledger. So they'll have a separate schedule on what they owe in a detail. And I want you to understand that piece. And obviously you have the same thing on the payable side, but that's not the particular thing we're going to discuss here in this chapter. Now, if you have a sale on credit, here's what we talked about. See here, this is what we were just talking about. You have a control account that's called accounts receivable, but you have two subsidiary accounts, Brown and Smith. And those won't be maintained in the ledger. They'll be maintained in some other core accounting system that ultimately these balance the subsidiaries of these. So if we had, say, 13,000 active students for the school, we would have an account number for each one of you guys that would roll up to this accounts receivable that they have on the school's ledger. That's what you'd have. Now, here's what the sale looks like. And I would suggest that in the real world, you would not see this as we talked about, where each name, you would just see accounts receivable, but you would know that you had these amounts. Oh, this is where they're paying for it. I take that back. This is where they're paying for it. And you would see this, but you'd probably see it not on whatever the account receivable account number is, but rather in the sub account number that you have that would relate to either Brown or Smith. Okay, now you have credit and debit card sales, and you notice here, this is a key point. They're treated as cash sales because the credit card companies, they guarantee a company that they are going to get the money for credit card sales. But what they do for that guarantee is they charge the retailer a certain amount of money based off of the credit card sales. So if they have sales of $100, the credit card company might take 4% of that sales and say, look, you can buy stuff for $100. Whoever bought the stuff from the store will pay you $100, but the credit card company is going to take 4% of that off the top, just for the right to use their card and for the credit card company to guarantee that you're going to get your money. So when you make that sale for $100, and we'll do numbers one here in a minute, you have two different ways to record it. You can record it at the net method, which would be saying you got $96 in cash, would be a debit, $4 in credit card expense, which would be a debit, and $100 in sales revenue would be your credit. That would be the net method. The gross method would be debit cash for $100, credit sales revenue for $100, and when you write a check to pay the credit card companies, you would take that $4 and you would credit cash $4 and debit credit card revenue, or debit credit card expense $4. So it will look a little bit different. Let's look at the numbers here. So here's the first one. This company had $3,000 in sales, and the credit card company charges them 4% or $120. So if they charge $120, they're going to use this net method, and it's also done with debit card sales. So they're going to debit credit card expense $120. They're going to credit debit cash for $2,880, and they're going to credit sales revenue $3,000. And some of you guys say, well, wait a minute, help me understand this a little bit better. Here's a prime example. Have you ever driven along the interstate and you see where they'll have a sign for gas, and it'll flash and it'll say $2 for credit, and it'll say $1.95 for cash. So they'll charge less for cash than they would charge for credit. That's because they don't have to pay the credit card companies their 4%. So if you had $2 for credit and you had a $1.95 for cash, the gas company makes out better because they're not giving 8 cents per gallon to the credit card company. They get to keep all of it in their pocket. So they say, well, I'll charge $1.95 if my customer is willing to pay cash. So when you see those signs on the highway, part of the reason you see that is this right here. So I thought you might find that a little bit interesting. Now, the next part, this is the gross method. In the gross method, you debit cash for $3,000 because it's like a cash sale for credit cards, and you credit sales revenue for $3,000. That's the gross method. And then when you decide to pay the credit card company the 4%, it's going to be a debit to credit card expense for $120 and a credit to cash for $120. Okay? This next section, we're going to talk about uncollectible accounts. Inevitably, when a business extends credit to another business, they are not always going to get paid for what they said. A customer is not always going to be willing to or able to pay what they owe. And what we're going to talk about here is different ways to deal with writing stuff off, receivables that we know we're not going to collect, because a company never collects everything that they expect to collect. And we're going to talk specifically about the direct write-off method here, and then we're going to go directly into the allowance method. In the direct write-off method, bad debts arise from when a customer isn't going to be willing to pay. And what you can do with the direct write-off method is you immediately write it off when you find out about it. And typically and then the next one that we're going to talk about later is the allowance method. But typically a small business is going to use this direct write-off method. If you're a business that, I'll say, installed heating and air conditioning systems for maybe a home builder, and something happens and the home builder says, well, I'm not going to be able to pay you, and you can just forget it, I'm not going to pay you, they would write it off only if and when that home builder says, I'm not going to pay you. Then they would directly write it off. They'd credit accounts receivable, and they would debit an account called bad debt expense. And let's look at a numbers example. This one is King. It says Dan King, not Don King with the fancy hair, but Dan King. And it said they figured out that Dan King is not going to be able to pay what he owes us. So we're going to do a direct write-off from accounts receivable into the bad debt expense account, and it's $200. So it says we are no longer expect to receive money from Dan King. And that's the first example, direct write-off method, not GAAP. Now, if the customer decides that he can pay after you wrote it off, well, what you're going to do is you're going to reverse the first entry and reestablish the receivable. That's where this debit and credit come from. So we're crediting bad debt expense, and we're debiting accounts receivable for $200. And now we've reestablished the receivable. But what we also need to do now is we need to pay, or we need to collect on the receivable. So the money came in, they sent us a check, and that's where the other half of this transaction is. It's now just basically applying the cash to the receivable and putting the cash in the bank. The second method we touched on just a little bit ago is allowance for doubtful accounts or allowance for uncollectible accounts, and it's an estimate of what we think we are not going to be able to collect, pretty much based off of history for the business. And they use this method, and it's really based off of the matching principle. And the matching principle says you have to match revenues with expenses. And so the allowance method says, based off of the numbers that you have, you're going to try and match those expenses and try and estimate what you expect your company is not going to be able to collect. And we're going to use a new account. It's a contra asset account called allowance for bad debts. And you might also see it allowance for uncollectible accounts. And it's really, it offsets, similar to how accumulated depreciation does for long-lived assets, it offsets the balance in accounts receivable, and you look at the accounts receivable and the net realizable value. When you look at financial statements, and I know some of you have by now because I gave you some exercises to do that, When you look at financial statements, you'll see a line that says accounts receivable net. And what that's doing is taking the accounts receivable balance and subtracting off of that the allowance for bad debts or the allowance for doubtful accounts. Same basic account, just two different words. You might see it one way or the other, and that's the net realizable value. So here's what happens. Here's the first one. Bad debts, just a simple allowance method. It says Smart Touch estimates that $80 of its $4,400 accounts receivable accounts is uncollectible. So for the direct write-off method, or for the allowance method, excuse me, they debit bad debt expense and they credit allowance for bad debts. Remember, this allowance for bad debt account is a contra asset account, which means the normal balance is opposite the normal balance of an asset. And when you look at financial statements, it's going to tell you accounts receivable net, and that's what this is telling you here. The accounts receivable net, and that's what you'll see most of the time. They won't disclose both of these, but you'll see this in the notes of the financial statements. But the accounts receivable net is $4,320. And then you have the allowance method that you look at, and you're estimating it. And as opposed to writing something off when you've determined that you can't collect it for certain, and then writing it directly off to the bad debt expense account, we're going to take an account write-off, and we are going to credit accounts receivable, and we're going to debit bad debt expense on a monthly basis or whenever it happens. But then on a monthly basis, you'll make an adjusting entry in the bad debt expense account, or the allowance for bad debt account, excuse me. You're going to make an adjustment to that monthly to true up your balance to what you think it should be. So here's what it looks like. It says, and this is one where they're writing something off in an uncollectible. It says that Smart Touch can't collect the money from Sean Clark, and it's $25. So they're going to credit accounts receivable, and they're going to debit allowance for bad debts. So I've decreased my total net AR balance, or accounts receivable balance, didn't change, but the distribution of it changed because now I no longer have a subsidiary ledger for Clark that shows that he owes me any money. That's what this $25 is over here. And I've written that off because I don't expect that he's going to pay me. But now on January the 10th, we didn't think we were going to be able to pay. But on March the 4th, 2018, we determined they could pay. So just like in the direct write-off method, what I had to do is reverse my original entry to reestablish the receivable, and then I had to show that I'm going to collect money from him, and that's just typically a payment on account. Very straightforward. Now, if we use the allowance method, we can look at three different ways in the allowance method to determine it, and you look at past experience, what's happening within the industry, and then some other variables. It might be economic variables as an example, and you have percentage of sales, percentage of receivables, and aging of receivables. And each one of these has a balance in it, and has a different calculation, and there's a purpose for each one. The percentage of sales is a straightforward calculation. You take the sales and you multiply it times whatever percent you determine is going to be your bad debt, and you get a number, and what you do is you debit bad debt expense, and you need to credit your allowance for bad debt. And so here's the example you have. We had 60,000, and they've determined that 0.5% or 0.005 is what they can't collect. So it's $300. And what this business is going to do is debit bad debt expense and credit allowance for bad debt allowance. If we look at percentage of receivables, we want to set the balance as a percentage of receivables. And so we're going to look at a targeted balance as a percentage of the accounts receivable, and you make some adjustments to that. And as opposed to reading through the list, let's look at some numbers. So here's the first one. It says that Smart Touch Learning and unadjusted accounts receivable balances $6,375, and 4% of the accounts is estimated to be uncollectible. So you're going to take 5% times 63.75, which is actually going to get you $255. But we already have a credit, it tells us, in the allowance for bad debt accounts at 55. So I only need to debit bad debt expense for 200 and credit allowance for bad debts for 200. So I'm not picking up the full amount, which would be 255, which is 63.75 times 0.04 is going to give you 255. But we already know that we had 200 in the account when we started, even though you can't see it here because we didn't have the subsidiary ledger for allowance for bad debts. We have that. So, but our ending balance, we want it to be 255. So we're going to debit bad debt expense and we're going to credit allowance for bad debts. Now we can look at the aging of the receivables as well. It's very similar, but we're using something called aging buckets. And the reason you look at aging buckets is the further away or the longer it is since the customer has paid, the greater the likelihood is that they are not going to pay the invoices that you owe. And so if we look at our accounts receivable aging, it shows that only 1%, we expect 1% of stuff that's current, that's due within 30 days is going to be uncollectible, 2% between 31 and 60, 3% from 61 and 90. But look at this huge jump from over 90 days. It says that we expect that 90% of what's in that account is never, ever, ever going to be collectible. So we write off the majority of that. And it says that our target balance is 185. And when we look at that targeted balance, we say, okay, our original balance in the account was $55. We need to get another 130 to hit our targeted balance of 185. So we're going to debit bad debt expense for 130, and we're going to credit allowance for uncollectible accounts for 130. So when we're done, our ending balance in our allowance for bad debt account is $185. Or you think, well, that doesn't sound like a very big number. But what happened if that was 18.5 million or 185,000 or some number that is just, we're missing 3 zeros. So it could be a whole lot higher. And here's the same thing with the aging receivables. And here's the journal entry we just looked at. Here's a comparison of the two. The one thing I want you to be clear on, or very, very clear, is the direct write-off method is not GAAP. It's going to be used typically by very small companies, and they're only going to write stuff off when they can't collect it. It might be just a local plumber, a local electrician. It might be a local landscaper that does work for people, and he determines when he's not going to be able to collect the money. And on the right side, it's more about, if you look, it's this is a write-off because we've written off what was in receivables and we've debited bad debt, allowance for bad debts versus bad debt expense. So our receivable balance has not changed here in net. Over here, it has changed because we've written off the receivable completely. Oh, my apologies. Let me go back because there's a couple more things I want to touch on here. And you can look, the recovery means that we just put it back on. And the difference here is the change in this account. The top part is the same, customer name, accounts receivable, but the bottom is where it differs. We reduce our bad debt expense and we increase our allowance account. We take it back out of the accounts. So really all we're doing is reversing the entries for both of these. And trigger heavy. And then the next one is just basically paying when they pay you. That's all there is to that. And then there's an adjusting entry that you do in the allowance method, and there is nothing in the direct write-off method. You just write stuff off as it comes and as appropriate. So this is a quick summary. I'm just going to leave you look at this for just a minute. The first one is on the left side, the percentage of sales, which is also called the income statement approach. Does not require you to look at the balances in the allowance for bad debt account. All you do is you make your calculation with the percentage of sales approach or the income statement approach, and whatever that number is, you're going to debit bad debt expense and you're going to credit allowance for doubtful accounts. On the balance sheet approach, you're establishing a targeted balance. So you have to look at what's in your allowance for bad debt accounts, and you have to determine how much of that really, what does that number need to be? So if you have $1,000 credit in the allowance for bad debt accounts, and you calculate and you determine that it needs to be $2,000, you're going to have to credit that and debit bad debt expense. If you determine that it needs to be $2,800, you're going to have to credit allowance for for bad debts, excuse me, and you're going to have to debit bad debt expense. So each one of them is a little bit different, but the two on the right, you're targeting a balance, and the one on the left, you're not targeting a balance. You're just taking the calculation as it is and going on. Now, notes receivable differs from accounts receivable in the aspect that notes receivable has an applied interest. And sometimes you'll have this business to business where a business is going to finance the purchasing of a long-term asset from another business. Maybe a trailer company buys up some land from another trailer company, and they don't want to go through the bank. They just want to pay for it up front, and that's what they do. So a note receivable has an interest rate. It has a debtor and a creditor. It has a maturity date, an interest period, and a maturity value. Each one of these are important. And what you do is you sign something called a promissory note. A promissory note says it's a promise to pay, and it kind of gives you some details, and they'll look a lot more legalistic than this, but this is a real simple one. It says that you agree to pay $1,000, and you're going to have to pay, and the interest starts on September 30th, 2017, and it says that they agree to pay Smart Touch Learning $1,000 within a year, basically, right? September 30th, 2018, and it tells you that the interest rate overall is 6%, and the interest rate is stated on an annual basis. So the first thing is when they do the notes receivable, they're going to debit notes receivable for $1,000, and they're going to credit cash for $1,000. And it's a 6% note on September the 30th. The first thing we want to do is compute the interest, and interest is established on an annual basis, and you can calculate daily interest rates, daily amounts, or you can calculate it by month, and we're going to use just by month here. But time is always a fraction of a year. So we have 3 months from the end of the note until the end of the year. So we're going to take 1,000 times 6% times 3 divided by 12, which is a quarter of the year. And it says that we need to accrue or put on our income statement and our balance sheet $15 worth of interest revenue expected from this note. But we also collect and establish that we had interest revenue for $15. So we're receivable for $15 and we have revenue for $15. Then when the note comes to maturity at the end of the time, we're going to collect cash $1,060, which is really the interest rate for the year. And this looked kind of silly right here with the 12 divided by 12. But what that's really saying is that's for a whole year. It's 12 months, and we're now at maturity, so it's 12 months. And we're going to debit cash for that amount, $1,060. We're going to credit notes receivable for $1,000. We're going to credit interest receivable, which we set up earlier at the end of the year for $15. And we're going to credit interest revenue for $45. So each one of these impacts your numbers and how you look at stuff, etc. But what we've done now is it says that this company got its money back at maturity from the borrower or the creditor. And if you have a dishonored note, it's going to look a lot the same. And here's what happens. We're going to convert it back to an accounts receivable, but we're going to add the interest, so now it becomes an accounts receivable. And then if we collect on it, ultimately, you're going to credit that accounts receivable. Or if you determine that you're not going to collect on it and you're using the allowance method, you still would write it off from there, and you credit accounts receivable and debit bad debt expense. Now, there's a couple of ratios that we look at relative to accounts receivable, and they're really current stuff. And we look at the asset test ratio, the accounts receivable turnover ratio, and day sales and receivables, trying to see how a business does. Let's talk first about the asset test ratio. The asset test ratio looks at really super current assets to determine whether or not the company is going to be able to pay back what they owe. The accounts receivable turnover ratio looks at how many times we can get our receivables turned over in a year. And then we look at day sales and receivable, and the two bottom ones are really linked together. So the first one, you can see here's the total current assets and current liabilities. We already know a current ratio is taking the 1 million divided by 1.5 million in 2013 and dividing it by the current liabilities, and you get about a 3-to-1 ratio, not quite 3-to-1, probably 2.8 to 1, 1.5 million divided by 600,000 is going to give you the current ratio. And that tells you, can you meet your current obligations, liabilities, if you liquidate your current assets. But you notice here as well, what you have is these top three are going to be considered the quickest cash out of all of them. So when you're calculating the acid test or quick ratio, you're going to focus in on the top three, and the remainder you're not going to look at. And so let's see how those look. Let's call this acid test or quick ratio. So you have cash and equivalents, short-term investments, and net current receivables divided by current liabilities. So you're 1.22 to the rounded. And does that tell you, is that a good number or a bad number? It's good in the sense that it's greater than 1. If it were less than 1, it would say that you don't have any ready assets or quick assets that you can convert into cash in order to pay what you owe. So that's kind of a scary proposition for a business. So that's the acid test or quick ratio. And then you have accounts receivable turnover ratio. You're taking the net credit sales divided by the average net receivables. The net credit sales in most businesses, maybe they're all credit sales. And the average net receivable is just taking the beginning and the end and dividing by 2. And it tells you that the amount is 10.48 times per year. But how do you put that in perspective? Take that 10.48 and divide it into 365. And it tells you that your dated sales and receivables are 35 days. So, well, is that a good number or a bad number? It really depends, and it's really a function of your business's credit terms. If your business has credit terms that are 30 days, maybe 35 is a little bit heavy, but you might have to look at it relative to the industry you're in. Maybe you're in the furniture industry and 35 days is okay. But you might also determine that 35 days is too long if you're selling, say, fresh milk. Because your credit terms, if your credit terms are net 7 and your number's at 35, boy, you got a problem. So you have to figure out why and get it addressed. And these are just kind of benchmarks, because what you can also do is look at this for this particular company that we're dealing with relative to industry peer companies, because they'll benchmark those, and you might look at the best of breed, or the one that's the most outstanding performer on daily sales and day sales and receivables to determine how your business is doing. And that's it for Chapter 8. I hope that you follow this and you got it pretty well squared away. And I look forward to discussing Chapter 9 with you. I hope you're having a great day.